Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron. Well, gold is on track for its best year since 1979, surging over 33% this year and breaking successive records. Now, the precious metal is currently trading at around $2,700 an ounce on the spot side. So what's driving the rally? Well, we got strong central bank buying, geopolitical tensions, increased demand from wealthy investors, and a shift by the Federal Reserve towards interest rate cuts. All of this has played a huge role. Now, in the third quarter alone, global gold demand rose by around 5%, setting a record for this period and pushing total consumption above $100 billion for the first time. This, of course, according to the latest report by the World Gold Council. And we're also seeing a significant boost in purchases from the non-transparent over-the-counter market, adding further upward pressure on prices, rather. Now, joining us to unpack what's happening is Joe Cavatoni. Joe heads up business strategy for Americas at the World Gold Council, and he has over 3 decades experience in his career spanning financial services, capital markets, ETFs, asset management, trading. Of course, before his role at the council, he was also the managing director at BlackRock, where he led iShares capital markets for the America. Hey, Joe, welcome back to Kitco News. Great to see you again.
Great to be back, Jeremy. Always fun to unpack the data for everybody in terms of the gold demand market.
Absolutely. And I mean, what a year it's been. You and I were just talking briefly off camera. And of course, you know, we got this new World Gold Council. They just released this benchmark report that you call the Gold Demand Trends Report. Now we know that global gold demand surged about 5% in the third quarter, setting that record, as I mentioned, for this period. And for the first time, pushing total consumption above $100 billion. Now, the report shows demand rising above 1,300 tons, driven by stronger investment flows from the West, including more high net worth individuals. Now, this is a big shift, Joe, since we know that the West has been sitting out this gold rally almost, and we've been seeing the Asian investors carry the gold price higher. So, you know, let's talk about this. What are the signs that you're seeing of the West getting involved here?
Well, it's a great topic. It's a really interesting moment for the gold market. And as you've highlighted, the first part of the year was characterized by that central bank demand, which I'm sure we'll talk to, but the Eastern investor allocating to their investment portfolios. And what we were waiting for in the West was a shift. The opportunity cost of holding gold versus other assets in a Western portfolio has been unfavorable for gold in a high rate environment. But the last Fed meeting we had, they cut rates by 50 basis points. We're in the midst of another moment of the Fed likely to cut another 25 basis points. That's overall lowering the real rate market and overall increasing the appeal of gold. That plus risk and the risk reward that comes from adding gold to your portfolio is bringing back the first signs, not all of it, but the first signs of the Western investor returning to the market, predominantly in the US. Actually, the European market's been a little slower than maybe we had anticipated. But again, these markets are lining up for an environment that's favorable for holding gold as part of your portfolio. And I would just put one more point out to say, and that doesn't say that the Eastern investor has gone away. We're keeping close watch of it. They're still strong in terms of their support and seeing record flows in that part of the world as well. But that Western investor is now looking at risk and return and looking at a rate environment that's more favorable to gold.
Yeah, I mean, it's so interesting. You mentioned a little bit as to why, but just as a background for our viewers, gold has registered gains every month this year, apart from a minor pullback in January and again in June when prices were a bit flat. So, I mean, getting back to the Western investor, I mean, the question is why now, Joe?
Well, again, I think it becomes a question of what the investor has been looking at in terms of how to hold their portfolio, what has been appealing to them. And when you're facing cash environment as a simple instrument that's giving you the high levels of return, the cost of holding gold in that kind of an environment is less appealing. But I think at this juncture, I think a lot of Western investors that we've been talking about are asking, hey, have I missed the run? Have I missed the actual price appreciation? Did I overlook gold because they were fixated on the rate environment, not seeing the global demand trends that were going to continue to move the price higher? And I think that what they're realizing is they haven't missed it. And I think that they're understanding that global demand profile is keeping the support for the gold price high. And we keep hitting those record levels. Now, here we are in a world where the first quarter, and I think it's been roughly 9 quarters reported that we've seen positive flows in the ETF market, in the US market. So it's telling us that the investor has not left the market. They've held their positions firm. They haven't added, but now we're starting to see the signs of them adding things back. They're looking at price returns. They're looking at the expectation of geopolitical tension. And again, most importantly, how it fits into their portfolio in an environment where real rates and other aspects of the market are going to start to look less appealing.
Yeah, I mean, you talk about the ETFs. It's been so interesting watching them. I mean, another interesting shift was the bullion-backed ETFs, the exchange-traded funds, flipping to gains in the third quarter, reversing that prolonged trend of outflows. You mentioned it a little bit there, but unpack it for us, Joe. Why were the ETFs so unloved up until this point?
Well, I think it's really important to, quote, unpack it.
Yeah.
What we would highlight is with price appreciation, most of the holdings, which are managed not by tonnage or units, but by dollars, most of the holdings in the ETF market were holding firm. The US AUM with price appreciations was increasing. It was actually increasing in line with price appreciation. So while we were seeing net flows out in the market, we weren't seeing Western investors in the US in particular adding to positions. Some were paring back their position, but not exiting the positions overall. Now, what we've seen that first quarter, as I've mentioned, in terms of net flows being positive in nine quarters, now we're starting to see the Western investors say, hey, look, I see what's happening on the horizon. I see the rate market moving in a direction where we're likely to see an outcome in terms of how the Fed's going to stick this landing. And they're actually bringing the allocation level back. You had a very strong period of over 4 to 5 months, amplified over third quarter for the year, where you see significant outflows in the U.S. of about $5 billion. Turned to about $3 billion positive now. So that's an $8 billion shift. Again, the market overall, though, is still a very, very healthy tonnage in terms of what's being held by ETFs. And overall, worldwide, it's about a $230 billion market. So it's still material. It's still the big holdings. Again, the Western investor in ETFs are starting to show the signals of saying, I'm coming back in to increase my allocations to gold. Now, just on ETFs in general, I think it's really worth highlighting that a secret standout in the ETF market has been what's been happening in China, Japan, and India. If you see the flow there year to date, even going beyond third quarter, you'll see that the numbers very, very healthy. It's a $5 billion inflow in those markets, telling us that, again, we've watched the Eastern investor emerge as someone who is allocating the gold in a major way. They're still at it. And actually with some volatility in markets like China, but they're still at it. And we're seeing gold as an investment really fitting well into this environment of change that we're facing right now on the monetary policy side.
Yeah, how much of it is just flavor of the week, turning from the S&P gains or this AI boom? I mean, well, what's the driver that's really changing this perception now to the US, to the Western investor?
So I think we've got a couple of things at play. The global investor is basically looking at geopolitical tensions, diversification benefits, and also some of the challenges around the dollar and dollar-based assets. There's a big challenge with Western fiscal challenges in the U.S. market. But I also think that people on the investment side are looking at diversification and looking at what you gain by having gold in your portfolio. With the steady returns, with the ability to understand that it actually lowers your overall risk-adjusted rate of return in your portfolio, and it gives you a liquid instrument in an environment where cost-effectively it becomes easier and more palatable to hold. That's what's driving their interest in it. They're looking at how we're coming out of this inflationary environment. We're looking at a landing, and they're simply saying, I need that diversification in the portfolio. So it's a shift into real assets, looking at assets that preserve value. And again, I've highlighted this before, and I'll say it again. That asset that will respond the right way when you start to see volatile markets, like you pointed out with equities, selling off 5, 10, 15% in a day, gold holds its value. That's the kind of diversification benefit that is getting a lot of attention from investors. And again, I think they're thinking about gold in that way, and it's actually becoming more appealing in the rate environment that we're seeing the Fed manage to right now. Again, this week we'll see. The expectation is virtually that there'll be another 25 basis point cut, and then we'll continue to have the discussions around how does the landing look or where do we go from here. But remember, it's a long runway that we're on, and investors are going to be back at the table. We're continuing to see the signs of it. I would again point to Europe. It's one of the markets where we're seeing a bit of a mixed environment in terms of new dollars coming into gold. Still a market that's seen outflows and hasn't really come back to the table, even with early signs of rate cuts. monetary policy. I think there's a couple more dynamics at play there around just what the alternatives are and how the environment is developing from an economic perspective. So it's a wait and see on the Western investor in Europe. It's a definite keeping a close watch on the Western investor in the North American market and actually on the Eastern market. It's a keep watching because it continues to be a strong spot in the market.
Yeah, let's talk a little bit about these opaque, these over-the-counter market, as we call it, the OTC, which has been showing up more and more in your reports this year. Over-the-counter or OTC transactions, of course, are done through dealers or between buyers and sellers directly without an exchange. So first, Joe, can you explain what this is to our viewers and why these transactions are so unclear and murky?
Well, I would qualify to say they're not murky. I would qualify to simply say, like the bond market, we have a large market that's supported by over-the-counter activities. It's not on an exchange, and it's actually a bilateral environment where professionals or even smaller organizations are trading amongst themselves. But what you have to understand about the gold market is pretty simple. Supply and demand plus mining, that all equals. And at the end of the day, it has to balance. That OTC market is where there are transactions that are taking place likely in the physical market for bars. And those are being basically transacted in an environment where we can track and trace everything we can, ETFs, futures, other bars and coins, retail investments, etc. But then there's that component saying, well, we know supplies at X, that demand that we can track plus the additional amount needs to tally. And that's actually where we get to the OTC space. I'd simply say to people, understand it as being a physical market of bars that are transacting amongst professional investors and understanding that it isn't something that should be seen as murky. Rather, it's just something to understand. And when you talk about that, you can understand it very simply by simply thinking about when a wealth management platform or a high net worth individual or private family office owns gold, they may choose to buy it in physical form. They may hold it either in their own possession or at a vault. But in that sense, you'll see gold being consumed, but that's off the ability for us to track it. So it basically gets tracked in that OTC number. So think about it as physical demand moving between Western and Eastern and all different types of investors, but actually trusted numbers. And actually it's an increased level of physical trading activity in the market and likely ended up in the hands of investors. That's the anecdotal color we've been getting from Asia, also in Europe, from some of the high network platforms and some of the family offices that we've been in touch with.
Right. So, it's very hard to track on the OTC side, but could we be underestimating this category then?
I think supply and demand have to tally and equal. So what I think we're reporting is probably understanding that that's the number that's in play. What I think is important is if you're estimating where it's going, it gets a little bit challenging. So it might be going to, like I've said, a private bank in Switzerland, or it might be going to a family office in Asia, but it also might be going to an unreported number with a sovereign wealth fund, or maybe pension that's internationally oriented that doesn't need to report their holdings. Think about it as physical demand, trusted gold being purchased into the hands of someone, and we can track it the best we can by tallying it up as that OTC number.
Yeah, it's interesting, even unpacking the sovereign funds, because OTC investment almost doubled year to year to 137 tons in the third quarter. Almost doubled. This was the seventh consecutive quarter in which OTC investment has been positive for gold demand. You mentioned the sovereign funds. Well, what are these particular reasons that we're seeing this shift here on the OTC side particularly?
Well, I think what we're seeing, and actually to your point, again, it's likely investment. It's likely coming from those that are looking to take a position in gold in physical form. And that, you hear a lot about the physical markets getting a lot of attention. You hear things like Costco selling gold in the physical form. These are all really interesting sound bites. Again, this is the place where you'll see a lot of that large scale investment going. As it relates to the sovereign wealth funds, I put them in the similar category as you'd see with not only investors, but also in central banks looking at global geopolitical risks, looking at global impact of gold as part of a portfolio investment, and looking at the future of the dollar and seeing what's going to play out with dollar assets. How is this new administration that we should be hearing more about over the next 24 to 48 hours going to tackle the critical challenges of the unsustainable levels of debt in the U.S.? Now, I'm not saying we're de-dollarizing, but what I'm saying is that many of these investment companies are looking and trying to understand, how will this play out? How will it play out over time? And what's the best alternative to a reserve currency like the dollar or the euro? It might be gold. And that's why allocations continue. That's looking outward. When they look inward and they simply see the benefits of having diversified to gold onshore as it relates to their own homegrown inflation challenges, the need for liquidity, and also the diversification benefits.
Right. Yeah. To your point, I mean, central banks have been one of the main drivers behind the higher gold price. In the third quarter, we did see a slowdown, but buying was still in line with 2022 and remained quite widespread here, Joe. So what did we see in terms of the third quarter central bank buying on gold?
Probably the one moment in all of our careers where we have to say we're coming off record highs. And when we have numbers as big as they are, we're sitting back and going, oh, gee, that's a little bit less than we were expecting. I mean, they're still magnificent and large numbers, and the central banks are still very much in the game, and they're still adding to their allocation. We've been signaling that we expected it to slow down since the 2022 record-setting year and new record-setting year in 2023. First half of the year was giving us signals that it might be yet back again at a record-setting level. But the third quarter's been a little bit more interesting. You've had pretty well-publicized slowdown in purchasing from China, but you still have Poland, Turkey, other central banks that are topping the list, continuing to add to their allocations. And actually, it's a robust environment of emerging and developing market central banks that continue to be driving the demand for gold. And actually, many of them continuing to have a strong case for continuing to add. So again, while we're off the record highs, we're still significant in terms of the impact it's having on the market. And I think what we've been seeing more and hearing more in the market is that when there is that dip in the price, that they tend to step in. And that's actually a really good signal for us to say, maybe there's strong support on a global basis for continuing to hold these levels, these higher levels, 2,700 mark you talked about. It's an interesting time for central banks to step in when they see dips.
Yeah, it's been fascinating to watch. Okay, talk to me a little bit about which central banks have been leading this gold buying spree that quarter. I mean, do you see this trend accelerating into next year? We're almost there.
Well, again, we're going to probably call it a little bit more cautious because the price is high. And like I said, they do buy dips, but I also think the case remains strong. Again, lots going to develop after we see the outcome of the election. Policies start to get put into place. We put a piece out that talked about watching the market for 3 to 6 months after the election to get an understanding of how policies will impact trade, different relationships, et cetera. But right now, you're still seeing a strong case from the emerging market central banks. Poland, Turkey, actually India has been back on the list in terms of not only buying, but bringing back to their own country their Indian stocks of gold. So it's actually quite interesting. China's been slow over the last 5 months, but the Czech Republic's been active. Hungary's been active, and many other countries. But look, the case still is very, very interesting and strong for central banks to keep adding and diversifying to their central bank reserve portfolio. So I think that what we keep an eye on is the pace. I think our expectation is, again, not to record set, but to continue to remain strong. And into 2025, not a lot on the horizon right now to tell us that the case is going to wane or slow in any major way. But again, it's about capacity, it's about the price point, and it's about the allocation level that they can get to. Most of these emerging market central banks are still allocated at a level where there's plenty of headroom to continue to add 3 to 4%, and there's up to 8 or 9, maybe even 10% of their reserve portfolio that's ahead of them. So a strong case, headroom to do it, questions around the timing, and we keep a very close watch of it. Monthly, we publish the report on what we see and hear. I'd encourage everybody to take a look because it'll give you the day-to-day blow of what's going on in terms of the demand that's been reported.
Right. Joe, you mentioned India there. I want to talk to you a little bit because we've been hearing about this repatriation of gold from central banks in New York. Talk to me if this is a trend that you're seeing it and who's been doing it.
I think it's probably a trend that we heard about, but probably the most vocal and the most notable has been India. And I think it's simply that they're looking to bring their gold back to the home country, having it mostly stored with Bank of England in Europe. I think it's just an interesting dynamic. I think it's an interesting opportunity to see how a central bank might see and view gold as part of their portfolio. But really, India is probably the one that gets the most publicity at this stage. And we keep an eye on whether others are having gold in their physical possession or not. I think Turkey's another example where they may choose to have a portion of their reserves on the home front. But as far as it goes, gold sitting in the reserve portfolio is good in London. It's good on the home front. It's good wherever they might have it, because that trusted network of trading, even in that OTC market we talked to, is where they want to have those reserves so that they can actually achieve that level of liquidity that they want. They want to be in the most liquid pools, London, or close to home, where they can actually make sure they can use it.
Yeah, how much of this is due to geopolitical situations? Obviously, we have what's going on in the Middle East between Iran and Israel. We see what's happening with Ukraine and Russia, not to mention China, Taiwan. So how much of this is to blame for that? And do you think that if that continues, this will continue into 2025?
I think geopolitical risk is definitely on the mind of everybody. Yeah. And I think that it's definitely on the mind of central bankers. It's hard to decipher between homegrown economic concerns, global economic concerns, and geopolitical risks in terms of the overall driving force of what's really pushing them to make moves at any particular point in time. But it'd be remiss for me to say it isn't on their mind. And actually, I think it's on all of their minds. And at this stage, I'd say it's going to remain a pretty high level of concern and question, and actually motivating factor for gold to continue to be in that portfolio. Again, a number of different factors that are driving the motivation, but geopolitical risk is on the minds of everyone.
Yeah, it certainly is. And we saw some interesting announcements too. I mean, the central bank officials rarely give any early hints in terms of when more purchases are coming. But last month, we had a little bit of an exception there. Central banks from Mexico, Mongolia, the Czech Republic openly highlighted the benefits of larger gold holdings, suggesting that gold as a share of their country's reserves is likely to grow in the coming years. I mean, these comments were made at the annual industry conference held by the LBMA, or the London Bullion Market Association in Miami. I think you were there. To stay on this theme for a second, Joe, what does this signal to you and to the council?
I think it signals, again, we see gold demand from central banks at about 30% of the demand on an annual basis, and at 25 to 30%. And it's going to just continue to be prominent. And it's actually globally motivated by just more factors than what maybe many people had expected gold to be motivated by. All year we've talked about the Western investor being not interested in gold because of alternatives to gold from a carry cost perspective, or from a simple allocation to just cash in the bank. They've missed this trade, so to speak, because they've not understood the fact that the driving forces for gold demand are global in nature. And that's where central banks are looking at how they're managing their portfolio on a global scale, not only with U.S. concerns, dollar debt concerns, but also homegrown concerns. And what we heard at the conference last month in Florida with the LBMA was pretty simple. This makes us to add to our portfolio because of simple analysis of diversification benefits and the return profile that gold brings. Mm-hmm. It's actually fitting in the portfolio. It's a very similar conversation we had to institutional investors. It's the same conversation we have. Take a look, understand what you get from it, look at your risk-adjusted return on your capital, and you'll see that adding gold at certain points based on a portfolio composition lowers risk, raises return, smooths out the overall performance. And they laid that out nicely at the conference, and actually not a lot of discussion around geopolitical risks. Mm-hmm. Again, it's there, but the investment fundamentals for gold are what's driving their investment right now.
Yeah, well said. Okay, well, in contrast to the drivers behind the increased gold purchases, we also had this cooling demand for bars, coins, and jewelry, as you kind of mentioned. I mean, jewelry demand fell 12% globally, yet India bucked up the trend with this 10% increase. Talk to me about the demand drivers in India and why they appear so resilient against these global headwinds.
So India was a unique set of circumstances that I'll talk to in a moment, but just fundamentally for jewelry, remember that higher prices, when it's purely a consumer good, tend to slow down fabrication and then ultimately purchases by the end consumer. It's not necessarily where you go when you're actually feeling as if market risk is high or prices are high in gold, or your disposable income is necessarily in question. Right. So you basically would expect jewelry to slow. That's what we've seen. The exception, as you pointed out, is India. India had a change in taxes and tariffs that incentivized the local market to import gold at a large scale way. It may be sustainable, but we'll see how it plays out. But leading into an auspicious time of the year, leading into the holiday seasons, they moved quickly to increase the level of gold imports, basically consumption, on the fabrication side leading into the jewelry market. So again, a standout for the quarter, but not necessarily something that we think is long-term sustainable. We'll see. Again, the high price market, this is when you tend to see jewelry slow down a little bit. Mm-hmm. And that's what you're seeing in China, in the Western markets as well. Not a big surprise. So let's see what happens in the end of the year here. Again, we're coming into holiday seasons, and then we'll be turning the quarter into January, always looking for the auspicious times of the year for the big two, China and India, to drive the market. So let's see how it plays out over fourth quarter. But not a big surprise for us. We were kind of signaling that it was an area where we were going to watch. Now, if that gets offset by increased levels of demand, in particular in markets like India and China, be a really exciting time for us because, you might not see as much of a potential impact on gold as maybe you would have in the past when jewelry is showing off at such large scale levels.
Another surprising driver was increased technology demand. Joe, break this down. I mean, what happened in the third quarter? What sector is behind the increased demand in this side?
Yeah, I think it's consumer electrics and electronics and also chip manufacturing. And look, it's a small number overall for the demand profile, 7%. But again, showing signs of resilience and actually growth, which is exciting. It's not going to be the part of the market that's going to be a major driver of the price, but it's good to see that not only on the electronics front and the chip manufacturing side, that consumption there is not being quickly replaced with alternatives to gold. So it's actually showing signs of being a little more sticky. I think that's probably linked mostly to the need for the high quality conductivity of gold and supercomputing and so forth. So it'll be an interesting space to watch. But again, I put it in the context. That's a small component of the overall demand profile. What we've been talking to central banks, investors, consumer goods like jewelry, savings and bars and coins, which I want to go back to that topic. I haven't really addressed that for you. But ultimately, I think the tech space is an interesting one. It's a good one to keep an eye on. We'd like to see it continue to grow, but again, not going to be the driver of price. But back to your point on bar and coin, just very quickly, again, this is the real retail end of the market. And I think that what we've been seeing is investment's been strong and it's been somewhat slower, mainly because it's more price sensitive again, when it comes to bars and coins. So we're keeping a close watch on it. Western markets slowing for sure. Eastern markets, a bit of a mixed bag. Again, a shift potentially from bar coin to a more large scale investment theme in places like China and India.
Yeah. Have you seen any, obviously consumers, you walk into a store or even into a Costco at this point, a lot easier to buy a gold coin as opposed to a bar.
Yeah, absolutely. And Costco is still one of these topics that continues to come up, gets a lot of attention. Very interesting for sure. Trusted outlet for owning your gold and actually doing quite well with it. So it's interesting. Let's see if more come to market with gold as an offering.
Yeah, Joe, I've had you on the show a few times this year. We keep talking about these high prices of gold, and it's always surprising, unpacking these latest market kind of insights. But here we are getting to the end of 2024, if you can believe it. We talk about this election coming up. What surprised you the most in terms of demand in the third quarter?
I'd say to you, the India surge on the jewelry side was a surprise for sure. When we heard the announcement, it wasn't that much of a surprise, but it was a surprise to see that would be part of the government's interest level. And then I'd say to you, the speed with which the Western investors turned from negative sentiment to positive sentiment, but keeping a close eye on the European side of things. I probably would have expected European investors to be back at gold more so than they have been right now. But again, that fast move by the U.S. investors, really exciting and interesting for sure.
Yeah, and as I highlighted in the intro, gold is on track for its best year since 1979, if you can believe it. So obviously you see demand continuing to support the gold price at these higher levels?
It's hard for us to identify any reason that these areas of demand would slow much further. Mm-hmm. We'll see how things play out over the course of this week in the U.S. and then into the new year. But right now, the case at central banks remains a very strong and robust one. The Western and Eastern investor remain very active at the gold table. So very much a topic of discussion. Maybe China stimulus might take a little bit of interest away from safe haven assets and put it into risk assets onshore in China. We'll hear from China this week about their stimulus package as well. So not only U.S. news, China news, really kind of interesting stuff happening this week. So watch the space is, I guess, what I'd say. But again, back to your question, not a lot of reasons for us to see a very large scale way of gold demand slowing.
Right.
Maybe curtailing, but not being anything radical that we can identify at this stage.
Yeah, well said. Joe Cavatoni, Senior Market Strategist for the Americas of the World Gold Council, joining us from New York. Thanks again, Joe, for this. As always, we appreciate your time.
Thank you for having me.
Thanks, Joe. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. As you just saw Joe mention, we got a packed week full of data, election, of course, the FOMC meeting, and more of China. Stay tuned. We got great content coming your way. We'll see you next time.